for us this morning. Okay, today's Thursday, the 13th of January. As usual, we'll start with the economic calendar. So we'll go to Thursday. So here we are. That's Thursday, the 13th of January. We've already had this report of high importance that came out from Australia at midnight. Obviously, that will have an impact on the Australian market and the Aussie US dollar. But we're focusing on the Euro US dollar. So let's go to this morning. So we can see here at 9:30 we have the British Industrial Production Report coming out at 9:30. So that would have an impact mostly on the pound US dollar and obviously the FTSE. And then at 12 o'clock we've got the big one. At 12 we have the Bank of England rate decision. So that's a report of high importance. Always remember that the four reports are always of high importance. So you always have interest rates decisions are always reports of high importance. Inflation figures, the consumer price index, the CPI index is always of high importance. Unemployment figures are always of high importance, and the GDP, the gross domestic product report. So those four reports are always of high importance. So we've got the Bank of England rate decision at 12, and at 12:45 we have the European Central Bank rate decision. So they're coming quite close to each other, 12 and 12:45. So that would obviously have a huge impact on the market we are looking at, which is the Euro US dollar. So you always remember that the market tends to trend sideways prior to report of high importance coming out. And since we're focusing on the Euro US dollar, we have to be careful trading prior to 12:45. Usually it's better to not trade at all. If you're a very cautious trader, it's best to keep out of the market entirely till after the report comes out before you place your trades. But what I usually do is I place one very cautious trade prior to the report of high importance coming out. But if I lose out on that trade, then I stop trading till after the report. So that's 12:45. Let's go down, and there are no more reports of importance after that, of high importance. We do have a few reports at 1:30 of medium importance coming out from the US, which will obviously have impact on the Euro US dollar. But the main one is 12:45, the central bank rate decision. So with that report coming out in mind, we'll go to the markets and the charts and see what we'll do about that. As usual, we start with the one-year daily chart to look for the overall trend of the market and also for swing trading opportunities. As you can see, that the market broke the moving average 50 there. That's the black line, the moving average 50. Broke that there, and it's trending down and started to go sideways. You can see it broke the Fibonacci retracement there once, rallied back up, and broke it again there on the 6th of January, and then it's rallied back up. But the market is still below the moving average 50. So from a swing trading point of view, we can still sell at the 38.2% Fibonacci retracement from a swing trading point of view. So I have already placed a trade there to sell at 13.056 from a swing trading point of view. Usually when I swing trade, I use a stop loss of 100 points. So if I sell at 13.056, my stop loss would be at 13.156. So I usually use a stop loss of 100 points. Again, that's just from my own trading experience, I don't like to risk more than 100 points on my swing trades. There's also what you call technical stops. So depending on how much capital you have in your account and depending on how much you can afford to risk in terms of your money management, you can use what we call technical stops. The 100-point stop loss I use for swing trading and the 20-point stop loss I use for day trading, that's just come from my own experience of trading and what I've found that works well for me in terms of trading and money management. But you can use what we call technical stops. So instead of placing when you sell at the Fibonacci retracement, the technical stop means you'll be putting your stop loss at a technical point in the market. So here, as we know that if the market is trending down, we don't expect it to break the moving average 50. So if you sell there, a technical stop will mean you putting your stop loss just above the moving average 50. So that's what we call a technical stop. So you're putting your stop loss at a technical point in the market. So that means you'll be risking about 200 points on that trade. So you sell there, put your stop loss just above the moving average 50, but then you'll be risking 200 points. And obviously you have to decide from your money management if you can afford to risk that. Or if you've got a huge amount of money in your account, you could actually use the previous retracement as your stop. So those are called technical stop losses, where you use technical points in the market. So that's where we will sell from a swing trading point of view. We'll sell out the Fibonacci retracement. That will be our entry point. And again, usually from a swing trading point of view, if the market takes my order, I'll either lose 100 points, but if it keeps going in my direction, once the market has moved about 100 points in my direction, I will move my stop loss to the opening level, then leave it there until the market gets to my profit target or takes me out. So that's a swing trading opportunity at the moment to sell at the Fibonacci retracement for Euro US dollar. Okay, so we'll now go down to a day trade. Now, from a day trading point of view, we'll remember that the reports are coming out from the Eurozone, the central bank interest rate decision at 12:45. So remember, the market tends to trend sideways prior to reports of high importance coming out. So you have to tread carefully. Like I said, if you're a cautious trader, you just keep out of the market till 12:45. But what I tend to do is place one cautious trade just in case the market decides to trend before the report comes out. And like I said, if I lose out on that trade, I'll stop trading till after the report comes out. So as we can see here, the market is trending sideways. You can see there isn't much activity in the market. And that's obviously in anticipation of the report coming out. But the good thing is that we can see that the pivot point here is well clear of the sideways trend. And it's also just above the Fibonacci retracement. So what we could do is we'll place a pending sell order just below the pivot point at 13,076. So if the market decides to fall before the report comes out, we'll be happy to sell just below the pivot point. And like I said, if it takes the order at the pivot point, goes back up and takes us out, and we lose out on that trade, we'll just stop trading until after the report comes out. So we'll place a pending sell order just below the pivot point and a pending buy order just above the first resistance at 13,196. So those will be our pending orders on the Euro US dollar between now and 12:45 when the report comes out. Like say, if one of those orders get taken before then, make sure you delete the other order, and that will be the only trade we'll place till 12:45. And like so, when you start trading on your own, you decide whether you want to trade before reports come out or keep out. And this goes back to our money management spreadsheet, making sure you make observations during when you're trading, see what happens in the market on a regular basis, and then you can make that sort of objective decision. So those are our pending orders now for Euro US dollar to sell just below the pivot point and to buy just above the first resistance.